Treasurer Mike Zurin here. Next, we have approval of the minutes for our meeting of January 11, 2024. Do I have a motion to approve the same without reading?
Motion to approve.
Second.
All in favor?
Aye.
Aye.
Aye. It is unanimous. Minutes are approved. Do we have any old business before the committee? Any old business? Hearing none. In new business, our feature presentation is from Eileen Stanek with our Lake County Investment Strategy Update. Ms. Stanek.
Thank you very much. And yes, happy spring. April showers, better bring some May flowers, right? But in any event, moving into the presentation here, certainly it's been a very bumpy ride to say the least. You know, as we look at economic growth, clearly we've had some very surprisingly strong economic growth, but the expectations are that economic growth may slow down. And the expectations for slowing economic growth are really what has been driving keeping intermediate to longer term interest rates down relative to short-term interest rates. The job market, of course, is one of the Fed's mandates for employment. And just as the economy has exhibited strong growth, so has the labor market. We had the March jobs number come out. It was surprisingly strong, missed the estimates by 100,000 people. The 3-month average now stands at 276,000 per month, which is significantly off of the lows that we were experiencing as the job growth was much slower, where average job growth was about 210,000 jobs per month. Unemployment rate now stands at 3.8%. And when we think in terms of really what has been driving this strong job growth, it has been in the healthcare sector, as well as the government sector and the construction sector. And the construction sector, the job growth that we've experienced has been double what the average job growth has been over the past year. And we believe we can attribute that particularly to the infrastructure dollars that are being spent throughout the country. And as we know, a lot of that is being spent here in Ohio. Job openings are down from their peak of where they were back in a year ago, March of 2022. We had open jobs of 12.2 million. We're now down to 8.8 million. So certainly those jobs are being filled, and we've seen that through the job growth. Inflation is the big gorilla in the room, because that is truly the factor that has been driving the Fed's movement of raising interest rates very swiftly in 2022 and 2023. And of course, as inflation had started to increase at a much lower rate, i.e. a period of disinflation, then the Fed pivoted their objective with pausing those rate hikes, as well as starting to communicate that rate cuts would be in order. So inflation, of course, as we can see here, peaked, looking at the PCE measure, which is the Fed's preferred measure, peaked at 7.1%, the core number at 5.6%. Last week we were at, on the core at 2.8%. So clearly approaching the Fed's target of 2%, but the other component that is also disrupting the market of late was the consumer price read yesterday, which came in on a year-on-year basis with inflation at 3.5%, and excluding food and energy at 3.8%. When we dive into the details of those inflation numbers, the component that's attributable to shelter, so meaning housing, and there's a very complicated formula that goes into play that's taken into consideration as they measure that cost of housing. That has accounted for 60% of the increase in inflation. So clearly the inflation is not necessarily broad-based. It's very much focused on the housing component, and then interestingly enough, another component is the price of car insurance. So there's been a little bit of catch up there with insurance companies on their rates, unfortunately. But when we look at what does this all mean for the Fed, coming into really the end of the month, last month, the expectations were that the Fed would cut rates 3 times in 2024. The strong job numbers in conjunction with inflation not, increasing at a slower pace has now contributed to the market's expectations moving to expect that we will perhaps only have one rate cut in 2024, and that first rate cut that we may see, instead of being perhaps in July, would be at the September meeting. And then the next cut would not be until starting in 2025. The expectations, though, do remain that as, it still is not a matter of will the Fed cut rates, just still a matter of when will that occur. So clearly, market expectations, interest rates, the level of interest rates do change as these components vary. And of course, that volatility is then translates into what happens to interest rates. And so here we have U.S. Treasury rates at various points in time, starting out with January 2023, which was kind of a low point, coming into the peaking in October of 2023, which is the turquoise line. Rates settled back down in January 2024, and then, of course, the orange line shows where rates have moved up as they stood at the end of March. Now being just 11 days into April, though, we have seen continued upward movement in interest rates, and we now have the two-year Treasury bumping up against 5%, and the five-year U.S. Treasury around to 4.60%. So these are approaching the highs that we experienced back in October of 2023. So it's not as though this uptick or kind of slowing of the pace of inflation is putting us at new highs on rates. We're just approaching, again, our highs that we experienced back in October of 2023. Okay, so looking at the county's investment portfolio here, at the end of March, cash versus securities. Of course, cash, this includes the engineers' monies of about a little over $40 million, as well as the fact that includes significant dollars related to tax collections. The securities portion was just over $250 million. Weighted average maturity is at 2.38 years with a yield of 3.01%. That has picked up from where it was at the end of December. We were below 3% yield on the portfolio. So as we have had funds available for reinvestment, we've reinvested them out in that 4 to 5 year area, as we had discussed, at rates exceeding 4%. That is accretive to the overall portfolio yield. This quarter, we do have about 5% of the portfolio maturing. And so again, our expectations would be that we would continue to build up that longer term portion of the portfolio, thereby locking in income, providing some more budget stability for the county. Our objective would be to have about 40% of the total dollars locked in beyond 3 years. Today, we are at 38%, so we certainly have some room to continue to build that. And of course, as time passes, what is a maturing in the 3 to 4 year bucket rolls down in the 2 to 3 year bucket. So that frees up some space. But as we can see with those yields on the per buckets, those of course have been growing, and the dollars that we have maturing in the 4 to 5 year area, we have locked in excess of 4%.
And I'd like to make a few comments. I'd like to thank Peter and Senator and also the investment committee, Commissioner Pleshnik and Commissioner Regovich, for all the hard work on the investment portfolio. There's been quite a few changes that have happened over the last couple of years. We've really looked at not only the treasuries and maturity dates and the maximizing investment, but working with local banks, CDs, which compared to an overnight rate, a CD could offer up to a 1 year fixed return, which is a significant difference than if you're looking at an overnight investment or a shorter term treasury. And we have also incorporated a lot of corporate bonds, and corporate bonds probably pay a good 0.5% higher than a treasury. So it's a significant increase. And I have some numbers which are really telling on what's happened over the last 3+ years with the investment portfolio. Last year, the investment return increased by about $12 million from 22 to 2023. But I have the investment numbers from the last 3 years. So in 2021, the county investment portfolio returned about $1.5 million. In 2022, it returned about $3.1 million. And in 2023, it was $15.2 million. And the projected return, if you look at the first 90 days return in 2024, the projected return for the county is $18.4 million. And that just offers so much to what the commissioners have to work with to serve the residents of the county. So I'm just thrilled and thankful to be part of the investment committee and all the hard work that everyone has done.
Thank you, Mr. Treasurer.
One other comment I wanted to make. I thought this was really telling. The rates are very volatile. So I took a look at overnight investment returns for the county, and Star Ohio is the portfolio that we put our investments in for an overnight return. November 30th of 2023, it was 5.59%, and right now it's 5.45%. I know that's only 0.14%, but that is a significant change. And to be able to watch that and be prepared to invest in long returns makes a significant difference for the return for the county. Thank you.
Thank you, Mr. Treasurer. So I would certainly second Mr. Zern's comments that we're very grateful to Eileen Stanek and her firm for their help as we continue to restructure our portfolio in a way that is both fiscally responsible and safe for the taxpayer's investment, but also maximizing the return so that there's less of a local tax burden for what we need to do. I would only caution about projections that obviously the other factor, it's not just the interest rate, the balance is the other factor, and we can't predict how much the various entities that represent that balance, because remember the $600-some million in that portfolio is not all Lake County government proper. That includes all the other associated Lake County entities like Lake Tran, for example, and many of them are spending their balances down considerably this year due to large capital projects. So we will certainly do everything we can on the investment end to maximize the return, but we need to acknowledge that that balance is not likely to be as high at the end of the year as it is right now. So we hope it's a good number and it will be the best number possible, but at the same time I don't want folks to get overly excited because that balance is likely to come down through the course of the year.